Today, Bitcoin slides closer to $90,000 with just 2 days left in the year. And Tether co-founder William Quigley reacts to the pace of stablecoin adoption in 2024. Welcome to CNBC's Crypto World. I'm Jordan Smith. Crypto markets are in the red as we enter the final 2 days of 2024. By noon Eastern, Bitcoin fell about 2%, just shy of $92,000. Ether lost 0.5% and was trading at $33.33, while XRP dropped 6.5% to $2.01. Now, shares of MicroStrategy also falling 6% by midday after the company announced another spate of Bitcoin buying, this time to the tune of $209 million. All right, let's talk about the top story before we get to our interview of the day. Following more than a year of efforts, former Terraform Labs CEO Do Kwon is set to be extradited to the United States. According to a translation of a Friday statement, the Montenegro Ministry of Justice approved Do Kwon's extradition to the U.S. over South Korea, where he's also wanted and where Terraform Labs was founded. He faces charges in both countries related to the crash of depegged algorithmic stablecoin Terra USD, which many point to as the catalyst for the 2022 crypto winter. All right, for today's interview, Crypto World's Mackenzie Sagalos caught up with William Quigley, co-founder of WAX. He's also the co-founder of Tether, and Mackenzie spoke with him about the growth of the stablecoin space in 2024 and whether new U.S. regulations in 2025 could pave the way for mass adoption.
So I want to start with your take on how stablecoins have really taken off this year, with all the talk around institutional growth and obviously the announcement from Ripple that it's launching its own stablecoin on Tuesday. How has that part of the crypto industry matured in 2024?
I would say not a lot has happened with stablecoins in the last year, which is not to say that's bad. Stablecoins are remarkably helpful in trading of virtually all cryptocurrencies. At least 60, maybe 70% of all trading pairs between different cryptos are between a stablecoin and Ethereum, Bitcoin, Solana, whatever that is. So stablecoins are the way people trade, and they are considered a safe harbor when there's volatility in the market and a trader wants to get out of that volatility. They park their money in stablecoins. What we have not seen, I would say, very much is stablecoins being used by the broader set of consumers for things like buying online, online shopping, paying, even peer-to-peer. We haven't really seen that. And there's a whole bunch of reasons probably why. But in terms of what stablecoins do well, and their primary purpose thus far in aiding the buying and selling of other cryptos, they do a great job.
How much do you think that institutions get stablecoins right now? I mean, we've got talk about tokenization and, of course, Bitcoin ETFs as institutions sort of figure out their strategy around crypto. But do you feel like enough work has been done among institutions to deploy stablecoins?
Well, no. I would say most non-crypto focused companies have a very limited understanding of blockchain and what a blockchain can do. And there's a whole bunch of reasons for why I think that. You just don't see obvious applications which could be useful using blockchain haven't been rolled out yet. And this technology's 14 years old. If you compare to what happened between sort of the dawn of the consumer internet in 1994 and then where we stood 5 years, 6 years later, I mean, the internet was prolific. And so I think the great majority of the companies were wishing crypto in general would go away. And so they didn't want to focus any attention on it. Any attention they did give it was strictly around the price volatility and how to make money allowing people to trade it, which is why once Gary Gensler, the head of the SEC, allowed Bitcoin ETFs and then Ethereum ETFs, people rushed in. And now a lot of financial institutions get people want to hold the crypto. But if you go one step further and say, other than trading on it, what about its utility in day-to-day commerce? I would say we're like 1994 internet, basically. Most companies this is not a priority for most companies. And which is surprising because payments is very important to a lot of companies, particularly cross-border payments. And there is no better way to conduct a cross-border payment than by using a stablecoin. And
to that point, Stripe has agreed to pay $1.1 billion for a stablecoin infrastructure company, a 200% markup from its most recent valuation. And I'm having conversations with other traditional fintech firms that feel like they're late to the stablecoin game and they're trying to play catch up. So 2 questions here. One, is this just a product of the fact that fintechs are sick of the fees that the big credit card networks charge and stablecoins offer a cheaper alternative? Or are we seeing more of a fundamental shift in global payment rails?
Well, this isn't the right forum for me to explain why stablecoins are the greatest innovation in money since fiat currency, and they really are. Tokenizing fiat is so powerful for consumers, businesses, and governments themselves that I believe within 10 years, all of the major economies of the world will have tokenized their fiat. And then we'll have a question. We have right now different types of stablecoins. We have privately issued stablecoins. That's like Tether and USDC. And then we have experiments in sovereign issued stablecoins. And you've got different governments, including China, who are trying to roll out stablecoins. They will do different things because they have different goals. But if you could get a number of companies to issue stablecoins, I think the costs of doing payments, particularly cross-border payments, would plummet. And you would be putting way more control over the payment transaction in the hands of the people actually doing it, as opposed to the intermediaries. And I think part of the reason why stablecoins were sort of neglected, one, they were associated with crypto, which is considered bad, lots of negativity in the press. And then the other reason is because very few business people, and I mean very few, understand the payment infrastructure. I think whenever I go through with business people, how many intermediaries there are between someone sending and someone receiving a payment, cross-border in particular, it blows them away. There's a lot of pigs at the trough taking their little fee. And stablecoins could make literally transactions be end-to-end, point-to-point. That's a incredible opportunity to probably take $1 trillion of costs out of the hands of about 5,000 global financial institutions and putting that back into the hands of businesses and consumers. So I think we're starting to see it. In 2023, we had the US Congress post a bill around stablecoins. It has not been passed. It's really not gotten a lot of traction. But I think the points that were made as to what should happen with a stablecoin or stablecoin legislation and regulation in the US were good. Having one-to-one reserves, having some sort of licensing requirement, having at least monthly reconciliations so you can tell that the assets underlying the stablecoin exist. These were some of the things that were in that bill. And maybe under Trump, we'll see something like that get passed.
I mean, it's a great point because one big barrier has indeed been regulation, but a lot of lawmakers seem optimistic that they can pass a stablecoin bill into law next year. What are your expectations there, and what should that legislation entail?
Well, I think one thing, it's a little unclear how the eventual sovereign issued stablecoins will coexist with privately issued stablecoins. I would like more meat on the bone there. Ideally, we should allow both, right? We should, the sovereigns of the world can issue their stablecoins, and those have certain purposes, and private issuers can issue theirs. I would like to see that, and I think part of the issue here is that there is no one in Congress and almost no one in American business who really understands the potential for stablecoins. And so when you're designing a regulatory framework for something like that, you don't really understand how impactful it can be. That legislation is going to be lacking in some areas. And of course, anything that can be sent digitally has less friction to go cross-border. And as I keep saying, this is where stablecoins really shine, because you avoid the necessity to convert currencies. This is where stablecoins have the biggest benefit to consumers and businesses. There's maybe $1 trillion of currency conversion costs in this $100 trillion global economy every year. And if we could keep coins in their native form and allow people to not have to convert to a particular sovereign currency wherever they're located, you would save all those conversion costs. I think that's part of the reason why there's been resistance on the part of the entrenched financial institutions, because this is a nice profit center, and it's actually an invisible tax. It's an invisible tax on commerce, because no one really thinks about, well, if I buy a pair of Adidas sneakers from a German company, I'm in the US, what the currency conversion was, because they'll just price it in dollars, but probably at an FX rate that's very favorable to whatever institution is enabling that transaction.
All right, that's all for Crypto World today. We'll be back again tomorrow, and we'll see you then.